All right. Back in the saddle here once again. It's about that time of day again here, folks. It's Tuesday evening. It's April the 16th, 2019. My name is Joseph, and this, of course, is your nightly newsletter. Now, remember, I help new traders find predictable, dependable, profitable trading opportunities using a simple three-step trading strategy that we teach and trade together every morning in our trade room. But my job tonight is a little bit different. My job tonight is to identify the best opportunities, the best levels, the best setups, and the best strategies to use for tomorrow. That's Wednesday's trading session. And we're going to cover oil, S&P, Nasdaq, gold, and euro in tonight's video newsletter. I'm going to jump in here right into oil tonight because oil looks like it is strapped to a rocket ship tonight and headed all the way, well, maybe not the moon, but possibly back to retest those highs from earlier in the month of April. Diving into the oil chart tonight, we have one hell of a short covering rally. Now, this might be a little bit of rollover anticipation here right now, but it looks to me like after a very strong 1, 2, 3 reversal, this thing is on its horse. Now remember, these types of markets have a very distinct personality because in all reality, it's not the buyers who are buying this market up right now, it's the sellers. What do I mean by that? Well, remember, we just finished this big collapse off the high earlier on, not this week, but starting off last week, as you recall. So all those sellers who are still trying to hold this market short for whatever reason, they're now being given a big dose of a stop run right now, right? Big dose of bullishness now going higher. So all those sellers who are still holding on for dear life right now, they're starting to get out, right? They're grabbing the lifeboats and they're bailing on their position. So remember, as this market rolls higher, what's actually happening is it's called a short covering rally. Now, these short covering rallies usually produce one of two scenarios here, right? I've got two specific situations that I'm ready for here to trade for tomorrow. Okay, I'm going to go over both of those situations, right? They'll cover both deep pullbacks, right? What if we get shallow pullbacks? What if we get deep pullbacks? What if the market goes range bound? The bottom line is there are two specific situations I always look for whenever I have a short covering rally. And we're going to break that down here in just moments here because I've got a big target now waiting on oil up around that 64.70. There's money to be made on this move back higher, but you got to have the right strategy to do it. So make sure you stay tuned for oil here tonight. We're going to dive into that Texas tea in a lot more details in just a moment. Over on the S&P tonight, S&P, as you can see here, little bit of a sloppy one here today. We definitely have a bear market right now, right, going back into that big trading range that we talked about in last night's newsletter. And to be very, very honest with you, there are two very big clues on this chart. One is the trading range. Okay, that's the easy one. The second one, though, is not as easy. It's this little tiny channel. Okay, now I've got those two clues, right? This trading range along with that tiny, tiny channel. Okay, ignore the big channel for now. The big channel isn't telling us enough. That small little channel. It's not what happened today, it's what didn't happen today, and that tells me where the battle zone is. That tells me exactly what type of strategy I want to trade here because I'm expecting this market to get back down to that big round number. There's the easy way to do it, and there's the hard way to do it. We're going to cover both of those options here tonight on this S&P. How about some Nasdaq? Nasdaq looks completely opposite, right, from its little cousin, the S&P 500, right? Nasdaq looks very bullish right now, right, but it's range bound. We call these spike and range patterns. Spike and range patterns are always very clear setups because they tell us to focus on buying the edges. But there's one thing about this chart right now, this kind of prickly, spiky price action, right? You'll notice strong move down, strong move up, strong move down, anytime I see, and I kind of call these, prickly charts, right? Because it kind of looks like if you touch that little spike right there, ouch, right? It's prickly. The bottom line is, anytime we see these types of prickly moves here, this tells us exactly what to look for, and most importantly, what to avoid here tomorrow. I've got a lot I'm going to talk about tonight on that Nasdaq and kind of the best way to trade these prickly price action charts here on the NQ. If you're an NQ trader like I am, make sure you stay tuned for more on that. Then how about some gold here tonight? Boy, gold, one heck of a move lower. I've got this listed as 1, 2, 3 legs down. But honestly, I think you could also look at this and go 1, 2, 3, 4 legs down. So one hell of a move down here for the bears. We talked about this last week, right? Anytime we see 3 legs, what usually happens? We usually end up going sideways. So it's not a surprise to see the market now going sideways. This is kind of the opposite of what we just saw on the Nasdaq, minus all the prickly price action that we have on the Nasdaq here for tomorrow. Most important thing though right now is gold tells me to look for ultimately 4 different scenarios. One is, or 2 of them will have to do with the buy zone below, and 2 of them will have to do with the sell zone overhead. I'm going to talk about trading breakouts, trading failures, and what might just happen if this market reverses, because I've got one more chart. I'm going to hold on to that one, though. One more chart later on. If you're a gold bug like I am, right, you'll be quite interested to see what some other time frames are looking like right now on gold. I know. I'm not the guy for multiple time frames. I'm not the multiple time frames guy. You know me. But I couldn't help. I couldn't resist. Get some very interesting stuff tonight to talk about right on the gold, because there's a very distinct personality that happens when a market moves like this. And we're going to talk a lot more detail about that yellow metal tonight. So make sure you stay tuned on that. And then how about that euro? Boy, ugly chart here tonight. Euro's a flag pattern right now. Right? It's a flag pattern. Strong move up into this lazy. I was going to call it a Greek channel earlier on, but I thought that might be a little bit too insulting to all my brethren from Greece. I'm kidding with you, obviously. You know I'm kidding with you. Anyways, the bottom line is, we've got this lazy channel here. You know I love everything about Greece. Anyways, keep going, Joe. Anyways, so look at this lazy channel. Now, this is a bear market at this point, but there's a couple things we notice right now that we're not getting, right? The sellers are not getting some key aspects locked in here for a sell. In my opinion, this could easily end up going lower, and I don't want to chase after because that level's down here to worry about, right? I also could call this, right, going higher, but we go higher here, be ready to sell it back down, or maybe it's just a bull flag and we're looking for a big measured move, right, going higher here. So I've got 3 basic scenarios. 1 is the downside, 2 is the up and down, and 3 is the up and through back up to retest those highs here, right? No, nothing wrong with being a Greek channel at all. I'm kidding with you. We're going to break those down here, obviously, right? We're going to break those down here with you here tonight on this video newsletter. So we got plenty to talk about tonight. We got a flag pattern on the euro. We got the gold with 4 legs down. Nasdaq with that prickly price action. S&P, of course, gives me that little channel, tells me what to look for. And of course, over on the oil is in liftoff mode. Before I break this into pieces, though, before we break this all down and put the strategy together for tomorrow, Wednesday's trading session, I want to remind you guys, make sure you never miss another great video newsletter. And to make sure you're always the first one to watch every night, just join our mailing list. All I need is your name, your email address, and then hit that subscribe now button. And don't forget, when you subscribe to the list, okay, make sure you check your inbox. Check your inbox, because I'm going to send you a welcome email with all kinds of goodies. And don't forget, sometimes these emails go into your spam folder. So if you don't see the email from me in there, check your spam folder and make sure you add School of Trade to your whitelist. That way you always get the good stuff from us right here at schooloftrade.com. If you're on the YouTube channel right now, I'll put all the links in the description, right, of that YouTube video. And speaking of the YouTubers out there, if you're on our YouTube channel right now, or if you're anywhere else on the planet right now, I need your help. I need your feedback. What do you love most about this video? What would you tell me to remove, right? If you had your choice, what would you see more of? What would you do less of, right? What's a market that you hate? What would you like to see removed? What's the one market that you always look out for every day? I would love to know what you want to keep and what you would want to change. What do you love? What do you hate, right? Give me some feedback in the comment section below. Drop me a comment below the video tonight here. And while you're down there, give me your honest feedback so I can always improve this video. Give me a thumbs up if you like value here every night. If you tune in every evening to this nightly newsletter, if you use it like I do to get ready for the following day, give me a thumbs up right on that YouTube video, because it means the world to me when you guys support this video newsletter. I work very hard every night to put this together for you guys. So thank you so much for showing your support, and don't hold back any punches. I want to know what you love and what you hate, and you're more than welcome to say you hate those bad trading jokes. I know. I try to have some fun with you guys here as much as I can on the newsletter. And then last but not least, if you have any questions for me, if you want more information on the charting software, data feeds, brokers, membership, joining the free trial, whatever questions you might have on there, right? Grab that toll-free phone number or use that live support tool and reach out and ask for help if you have any questions along the way. All right, let's break this party down here. Let's get this party rolling here. Tomorrow's hump day. Mike, what day is it, right? Tomorrow's hump day, April 17th. Tomorrow is Wednesday. Now, I warned you about tomorrow in last night's newsletter, right? Tomorrow, of course, is the Chinese GDP. Well, it's not tomorrow. It'll be late tonight, right? So you're going to see the GDP from China, right? This is the year-over-year GDP for China, the yearly adjusted GDP. It's a big deal, right? So GDP report coming out in China. Usually they report those about midnight, 1, 2 in the morning. Asia markets will get it first. Obviously, London markets will pick up right from there, and then we will see the tail end tomorrow morning. So be aware of this, guys. I'm going to do everything in my power tonight to set these charts up and get them ready for tomorrow. But while we're sleeping here tonight, at least in the U.S., right, we may have some updates to do tomorrow morning because of that GDP coming out late tonight, early tomorrow morning while we're sleeping, right? Right when the alarm clock goes off in Asia, right, they'll start getting that GDP number, right, coming out. So be aware of that. Big news report, right, coming out here in the overnight session. And that really leaves me as a U.S. session trader just kind of waiting to see how the markets will react. And then tomorrow morning, we'll update our charts, we'll adjust things we need to adjust, and we'll go into battle together in our trade room. Tomorrow morning in the trade room, we're watching the international trade number at 8:30 Eastern time. And of course, we got that weekly petroleum status report at 10:30 Eastern time. Now, I'm pretty sure I talked about this yesterday, if not this week. There was supposed to be an OPEC meeting tomorrow as well. I believe they have postponed that meeting now until the June meeting. So if you're worried about an OPEC meeting tomorrow and getting an OPEC announcement, it doesn't sound like that's going to happen tomorrow. I always go every month. I always go to the OPEC website and check their monthly calendar like I do every month for all the different stuff. And we talk about all that stuff, obviously, in our beginner classes because I have a monthly ritual that I go through where I check all the holiday calendars, check things like the OPEC schedule, the OPEC schedule, things like that. And I'll go over all of that in our beginner classes here at School of Trade. That way you know what to do with me each month. But the bottom line is there was an OPEC report scheduled for today. It appears they have postponed that, right, for the month of June. So we will kick that can down the road. So all we have to worry about tomorrow is that petroleum status report. Right now, don't forget, this is not your average news report. My strategy on a Wednesday morning when it comes to oil is I bracket this news out. So what I'll do is after 10 a.m., I'm hands off, and then after 10:40, we'll get back at it. Because that news report is such a big deal at 10:30, the markets tend to slow down pretty bad after 10 o'clock. You can try to trade it, but most of the time it's so darn slow after 10 o'clock because everybody's so scared stiff, right, of trading during that petroleum status report. So I always tend to back off at 10 o'clock, and then at 10:40, a good 10 minutes after, right, then we'll get back on the horse and we'll start looking for it. This is only for oil trading, of course, right? This is only for oil because this, of course, is the weekly, it's known as the weekly inventory report, right? The weekly inventory report. This, of course, is called the petroleum status report online. Same stuff though, right? So make sure you're aware 10 o'clock is kind of that cutoff, and then after 10:30 we'll play it by ear, give it 10-15 minutes, and we'll get back in from there. So big news for tomorrow. I'm not sure how much international trade is going to make too big of an impact. I would imagine markets are probably going to be rebounding or reacting or responding to the overnight news from China. And then, of course, that big news report tomorrow at 10:30 Eastern Time, the weekly inventory report for crude oil traders. Other than that, right, that's pretty much all we got to work with, right? That big news from China tomorrow is the big deal. I also want to remind you once again that Friday is a holiday. It is the Good Friday holiday. It is Easter weekend. That means I will not have a newsletter on Thursday evening because there is no markets open on Friday. I would always encourage you guys, as part of your monthly ritual, to check the CME Group website to make sure you know when the markets are going to be closed. Pretty much every month we have some market closing, and you want to know when that is each month. We'll talk more about how we use the monthly ritual in our beginner classes here at School of Trade. But for now, though, let's get ready for battle tomorrow morning. We open up our trade room every morning at 8 o'clock Eastern Time. I hope I get a chance to see you there with me, right? And our job tonight is to get ready for this stuff, right, as we go. Now, first of all, jumping in here tonight, we got oil, S&P, Nasdaq, gold, and euro on the docket here for this evening. Let's talk about rollover, right? Today is what? Today is the 16th of the month. Usually after the 15th of the month, I start watching for rollover. Usually contract rollover on oil is around the 18th of every 1 month. Okay, remember, and here's a good rule. Here's a good rule of thumb, right? Crude oil is every 1 month, gold is every 2 months, and pretty much everything else is every 3 months, right? So you got your currencies, right? You got your E-minis, besides, of course, the agriculturals, things like that. But it's crudes every 1 month, golds every 2 months, currencies, E-minis, right? Those are every 3 months. So the way I always say it is crude's 1, gold's 2, everything else is pretty much 3. Okay, currency futures like the euro, E-mini, S&P, Nasdaq, Russell, Dow, things like that. So, and then again, because oil is every 1 month, it's easy to get into a rhythm around the 15th of the month. Okay, so kind of a good rule of thumb, around the 15th of the month, start to watch the next month's volume. So what I'll do here is I'll bring open, and this is NinjaTrader, obviously. You can use whatever charting software you want, right? Open up, again, this is the market analyzer or NinjaTrader, but take a look at the current volume, right? The current volume, and compare it. So right now we're on the 519 contract, and you can see the 519 contract has the most amount of volume right now, right? The 519 contract has 530,000 contracts. The 619 contract, right, only has about half of that. Now what's going to happen is eventually the 619 contract will have more volume. And once it does, bingo, now you trade the 619 contract. So how do you know when oil rolls over? When the volume on the next 1 month, right? Remember, every 1 month, the next month is greater than, right, the current month. So right now, we're on a 519 contract right now. That is the most amount of volume on the CME. So we'll trade the 519. Once the 619 has more volume, bada bing, bada boom, we'll trade that one as well. Okay, don't forget, you can't really mess it up. We're not talking about contract expiration here. You're not going to get delivery on a big barrel of oil at your front door, right, if you happen to hold it past the 18th. We're talking about expiration, right? That's when you got to worry. This is rollover. We're watching rollover as we go. So for all I know, by the end of the day tomorrow, I might be talking about the 619 contract. So be aware of that. We are keeping our eyes open. Now, Most important thing right now is this strong move up, right? Very strong move higher. Anytime I see a strong move in one direction, I always expect to see a pullback and a second leg. Anytime we see a strong move in one direction, we expect to see a second leg. And my job is to find a way to get in during the deepest part of that pullback, because if I can get in during the deepest part of that pullback, I can take a small amount of risk for an oversized amount of reward. Remember, if you can get into the habit of participating buying low in a bull market where you can risk small, right, to earn large, you have a very bright future ahead of you. Now, this strong move appears to have come out of nowhere, but if you look left, like I mentioned earlier, it's not really out of nowhere. This is ultimately one big trading range, right? This is ultimately one big trading range, and we're simply catapulting now off of that, right, off of that low. At the simplest way of looking at it, this is a short covering rally, right? The simplest way of looking at it is all the sellers who are still short, we assume now, they're getting out of this move. And the reason why that's important is because buyers are not the ones buying this up. Yeah, I know, we heard from the DOE this afternoon, we got a little bit of news this afternoon, but these types of moves are not related to that. These types of moves are sellers getting out. Now, the reason why that is so important to know is because if you're waiting for a real deep pullback, you're probably going to be waiting for a long time. Now, I hope we get that. Don't get me wrong. I hope we get that deep pullback. But the reality is these are not buyers buying this up. It's not like the buyers are going to go, oh, it's too high. We better wait for the pullback and buy it nice and low. It's probably not going to happen. What's happening right now is the sellers are going, shoot, get me out, shoot, get me out, shoot, get me out, right? That's what's sending this market higher. Okay? It's not the buyers propping this up. It's the sellers getting out. That's really important because that will help you understand why this thing's not going to pull back. It will also help you align your expectations correctly, right? By knowing this is a short covering rally, I now understand I don't need a deep pullback. I just need something that allows the buyers to buy nice and low. Now, we already got that 2-try breakout, right? Strong move up, 1 and 2 and go. If you watch my nightly newsletter religiously every evening, you know that pattern, right? You know that when we're in a range like this, when it goes strong move up, right? 1, 2, and you can buy into those stops. Okay, so if you're already in that or took that already for profit earlier on, hats off to you. Now at this point now, we are definitely too high to be buying here. And in most situations, I would say let's wait for a real deep pullback. And this would be the best scenario. I mean, don't get me wrong. I've got a beautiful reversal line over here, right? What is that? Triple top over here. That's going to be a beautiful spot here to buy off of that low. I've also got this hidden channel. I'm drawing off those highs, up off that low. That would be a beautiful spot to be a buyer. Hopefully we get that. I mean, hopefully we do. If I do get that nice deep pullback, it'll probably be a 2-legged pullback. Draw that trend line over and then use that trend line as a key level of support for the buy going higher, right? We call these a 2LP, a 2-legged pullback pattern. One of my favorite patterns. I just don't think we're going to get it. I just don't think we're going to get that deep of a pullback. I hope we do, but we probably won't, okay? So don't hold your breath on it. We may also see the market really take a nosedive. And if we do see it take a nosedive, right, not a 2-legged pullback, but if it does just really sharply pull back, now what I'll do is I'll look for that classic combination, that failure, right? Let those bears try to sell off the moving average. What will happen is as this market goes racing lower, the sellers will say, see, I told you it's going back down to retest those lows, and the bears will come in and they'll try to sell off of that pullback. Now that pullback, of course, is setting them up for disaster because once they sell off it, we're right off of that reversal line. We're right off the low of that hidden channel. It's such a bull market going higher here. The odds are so good that we go back to retest the high. The odds are stacked against the sellers on that. I want to be in the right side of the odds on that one, right? And so do you, right? I just want to be on the right side of the odds, right? I want the probabilities to be on my side, right? That's why the Vegas casinos are always so cool, calm, and collected, right? Because they know you can take your nickels and dimes, but they're getting the dollar bills out of your pocket, right? Because they're on the right side of the probabilities. The bottom line, though, is that knowing that the sellers are not on the right side, they're on the wrong side of that coin, I want to be a buyer right into their failure. And I'll buy right into those stops. Now, once we get that failure pattern, then look for that pullback, right, and buy it from there. Okay, this is a very, very common sequence. We see a deep pullback. The counter trend traders try to reverse it. We buy into their failure. We don't chase after it as it goes higher. We wait for one last shot for the pullback. So don't get me wrong. I hope we get that deep, deep pullback here, either a two-legged pullback or we call these failure setups, right, into breakout pullback setups, right? Breakout pullback patterns for that rally going back up to retest the high. What I'm also watching for, which I think is more realistic here, I'm going to get rid of that channel here just for a moment. What I'm also watching for is a spike in channel. A lot of times these strong spikes up, they'll end up going sideways here, right? Not sideways, but you know what I mean, right? In like this narrow channel. If I can get this into a spike in channel now I know exactly where the money's going to be. Now I look at these prior swings, I mark up these prior swings now, and now I look to buy that deep pullback. Now, what's the best pattern for that deep pullback? Well, personally, what I would do is look for that same sequence, right? Get that nice deep pullback. Get that moving average. Let's use this color here for a moment, right? Get that moving average coming over. Let those sellers try to sell off the moving average. Now we can be a buyer now into those stops, trade the pullback, right? And up we go from there. Like I mentioned, that's a very, very common pattern there. So watch out for that spike in channel. It's also a good idea too to keep your eyes open for a trading range. Right? This could easily end up going sideways up here. Maybe not here, but maybe a little bit higher, right? We go into that high. Once we see a double top, right? Once we see that double top, remember, double tops don't need to be exactly double tops. They just need to be close enough, right? So once we see that double top, then we know that becomes the range. Once we have a trading range, what do? We use that specific pattern, that one, that two, that failure. Let those bears try to go lower once, let them try to go twice, and then we're buying with the appropriate signal candle, right back up to retest that high. Okay, now, what if we don't go sideways? What if this thing just keeps on pushing? If it keeps on pushing as we go, you've got one more aggressive pattern. I talked about that two-try breakout pattern, which I'll go over in more detail in this video tonight here. But again, if you watch the newsletter every evening, you know about that pattern already, right? If we do keep going higher, be aware this area up here is the major target zone. The next best option would be a 1, a 2, and pay attention here, a trap low. Why? Trap patterns are the best patterns to avoid buying into resistance. Let those bears try once, let those bears try twice, and then we're buying that trap right off of that little trap low down there, right? You want to look for that pattern as we go higher. So now I've given you a bunch of different scenarios here, right? We have our deep pullbacks. Okay, deep pullbacks, we know, right? That two-legged pullback pattern, right? Or maybe it's the failure into the breakout pullback going higher, or maybe it's the spike in channel, right? Maybe it's that spike in channel. Maybe it ends up being a spike in channel and we end up deep pullback from there and buying that pullback. Or maybe it's a range up here, right? And we go sideways, right? To try failure. There are so many ways we can trade these markets, and I'm only scratching the surface on tonight's video. I want to give you a lot more to learn on this, and to do that, I want to give you access to our free trading class here tonight. In the upper right-hand corner, I'm going to drop a big link in the upper right-hand corner. I'll also put a big red button right below the video tonight on our blog here at Sideways Markets. Not to worry, pause the video, grab your access, right? Grab that registration for the free trading course. It'll be worth every ounce of time it takes because you'll learn all about my three-step strategy, the same strategy we use every morning in our trade room. You'll learn all about my favorite entry patterns, pullbacks, traps, failures, strength moves. Everybody loves the free trading class. So will you. Grab that link in the upper right-hand corner or hit that big red button below the video tonight on our blog. Let's keep moving, though. I got more to cover here for you guys tonight, and you guys are busy people like I am, so let's get this party rolling. Over to the S&P right now. The S&P, as you can see, is bearish overall. It's very easy to see this market is bearish. Now, when you put this into context, you zoom out a little bit further here right now, and you can see that the S&P, in all reality, right, this S&P is just coming off the high of this range, right? We saw a beautiful 1-2 try at the low, right? We talked about that a moment ago on oil. And of course, now here we are, right? That big run up, buyers try once, buyers try twice, and boy, I wish we would have saw that coming last. Oh, yeah, that's right. We did. We talked about this last night on the newsletter. Never mind. If you watched last night's newsletter, you were ready to sell the heck out of that top, right, on this S&P. I've already got a bunch of comments from you guys, so really great to hear you guys are listening, right, as we go on this. Beautiful job on that. So buyers, of course, didn't take the bait up here. They knew this was a dangerous place to be buying. Buyers try once, buyers try twice, and we sink back down into that trading range. Now, where's our target? Where do we think these sellers are trying to go? Well, make no mistake about it. Their first priority is to get back down to that low of the range, right? That is priority numero uno. That at 29.03 and 3/4, that is where we're trying to get to next. From there, I have to assume that big round number will be a nice little pit stop, a little potty break there on the way down to what will hopefully be a nice big pendulum swing. Now, you want to talk about pendulum swings. We're going to go into pendulum swings a lot more on gold tonight, so make sure you stay tuned for gold here because we talk a lot about pendulum swings tonight on that gold. Okay, so there's the pendulum swing now. So that is the ultimate target. There's my big range. The amount of the move above the range is the amount moved below the range. Bingo. 28.96. Let's just call that 28.96 and a quarter, right? 0.25 on that one. So again, the first target is down to the low of that range. Second target, right, is going to be that pendulum swing down at that 96 half area. That's where all the big juicy runner targets are waiting for us. So now we know where we're trying to go. But remember, we have a trading range. Okay, what's the rule of range-bound markets? Sell high. Buy low. Yep. Right. Buy low. And what else? Avoid the middle. We don't want to forget about that middle. I'll tell you, Mama told me a long time ago, Joe, stop fiddling with your middle, right? Stop. That joke always hits. That is always a great trading joke. Anyways, right? Stay out of the middle. Right, I know. I try to liven things up here a little bit. Everybody's so boring on these trading videos, right? I try to keep you guys on your toes here with some of these corny trading jokes. I know. I get a lot of good feedback about them too. I might write a book someday. I'm kidding with you. So stay out of the middle, right? Buy low, sell high, avoid the middle. Where are we right now? We're right in the middle, right? Stay out of this thing. Okay, not a good spot to trade. What I want to do is, if I expect the market trying to go down, right, I probably want to get up so I can sell high, right? Or if we go down, I'll then look to buy off that low. Okay, that gives us a general idea. Basically, it tells me stay away from this area here, okay, and look to sell it as it goes higher, look to buy it, right, if it goes lower. Okay, let's get ready for that. Now, how can I sell it? Well, I always like to use, this is a trending environment right now. It's a large range, but today was a trending day here, as you can see, right, on the S&P. When it comes to trending environments, I like to go with the direction of the trend. I want to sell. I want to sell at resistance in this case. I want to use a channel, and there are two channels. One channel here, right? That channel lines up those lows. This is a hidden channel. It fits beautifully off those highs, and this would be a great spot, right, to look for a chance to sell, right? That'll put us right at the top of the range where I want to sell the highs, right? Keeps me out of the middle. That's a great looking channel. Now, that location, put a pin in that one, right? Hold on to that idea just for a second, because then I want to talk about this channel. Now, you probably have heard me talk about the term before called a grind break, right? We call these grinders, right? We call these grinders in our trade room. We talk a lot about these in our intermediate classes. And what you want to be aware of is that when you see a channel, usually it's a relatively narrow channel, but it's not really that necessary to be narrow, but usually it is a narrow channel, right? When you see a nice little narrow channel, most of the time in a bear market, this market will pull back, about halfway, right? It'll usually pull back about halfway and then come right back down again. Okay, that's kind of how channels work, right? Well, what happens sometimes is sometimes they don't get a deep pullback. Sometimes they get a little shallow pullback and they kind of grind their way down and collapse lower. Okay, this is where that term grinder comes from, right? Kind of that grind break. Now, why am I telling you this? I'm telling you this because we see time and time again where that level overhead, right, the highest part of that pullback is a huge sell, right? Huge sell area there, and traders are always waiting above those areas to grab that sucker short. So that's why I'm drawing this up right now, because as you look back at that little channel here, right, if you were to look at that as the range right there, right, you would have thought they would pull all the way back here, let the buyers try to fail, sell it back down again like we normally see. But what happened? All they got was just this little tiny up, and then it dumped back down again, right? I would call it a grinder. It wasn't as obvious as typical grinders, but what's the one thing that didn't happen? It didn't pull back. The sellers, right, they never got their chance to sell high. Literally, the sellers are still waiting up here saying, hey, remember me? I'm still waiting, and they're going to be ready to sell up here as well. So when I combine the little narrow channel, which tells me to look at that area as a key level, okay, then I combine the low of that with that high. That gives me another important area. Not to mention, I already know I want to sell above the high of that range. Now I know that's a great spot to look for it, to sell back down. So now all I need is a good pattern. What's the best pattern that I could use here now to sell off of that high? Well, I think we can already see it setting up right now. We talked about this on the oil. One leg, pull back. If we get a second leg here now, let's draw that trend line and let's get back underneath it, use it, and sell it down from there. What do we call these, by the way? We call these two-legged pullbacks. Why two-legged pullbacks? Because one leg, two leg, right? Pretty simple. I know, some terminology there. Once you learn it, you'll never forget it. Pretty easy, right? Two-legged pullback pattern. Now, right, you could also apply this now to a failure pattern, right? So we run up above the highs. The buyers, of course, now, what do they think? They think we're going back up to retest the high, but it's not a bull market at that point, right? It's a bear market pulling back. We let the buyers try to buy the pullback. We know where their stops are, and now we look to sell into those stops. That's the failure pattern. Now remember, don't fiddle with the middle, Joe, right? Don't fiddle with that middle. Yes, Mom, I know, right? And we want to sell that pullback, right? Don't fiddle with the middle. Wait for the pullback down from there. Okay, now, I know what you're thinking. What if that move goes really strong here, right? I mean, you just told me, Joe, if we see a strong move here, isn't it going to want to go higher? Yes. So that's something you also want to keep your eyes on. If we do get this market now running hot, right? If it really pushes higher here now, and we're thinking we're going back up to retest that high, what's the best plan of attack here? Again, I'm looking for it to go up, pull back and fail up here. If it goes through that high on strength, now what's the best setup? I don't want to buy into the high up there, right? I want to look for that trap, right? 1, 2, trap, and go. That's the best setup if for some reason, right, these buyers take it higher. Okay, so watch that trap pattern again. If it just goes up, buyers try and fail, we'll sell off that high. But if it runs, right, if it really runs up here, watch those bears trying once, watch them trying twice, wait for that trap, right, and we'll buy, right, that trap from there. Now, what if the market drops, right? What if we don't get that pullback? What if the market drops down here? What do we want to do to be a buyer going back up in? We know where our targets are. What's the best type of pattern now? You guys know this. What's the best of a pattern to buy, because it's a range, but buying into a bear move? Because remember, what's going to happen? If it runs lower, the odds are pretty good they're going to get that second leg. I don't want to be on the wrong side of the odds, right? I'm on the right side of that coin. So I know we've got the pendulum swing down here. I know we've got this area. I want to buy back up. What's the plan? The plan is to use that nested failure. It's the same pattern we talked about last night. Look what happened. Price went up. The buyers tried once. The buyers tried twice, and then it dumped back in. That's the same idea here now. If we go lower here, let the bears try once. Let the bears try twice. Let them try twice to keep it going. Okay, remember, they have the odds on their side. So let them wrap those odds right around their neck, right? And once they're all drunk on the odds, right, then we can pound them higher here. Right? I'm obviously joking around by all that, but I'm just saying, let those bears try twice. And once they've got their positions filled, make them get in. Because like I talked about last night, right, like all those fighting sports, right, what do? You use your opponent's body weight against them. You use their momentum against them. Let them sell it once. Let them sell it again. Then when they're all loaded up and they can't do much from there, once you see that nice strong signal now, right, once we get the appropriate signal, then we know it's time to get in, right, and buy going back up into that range. So beautiful, beautiful chart here on the S&P. I've got some serious waiting to do because I don't want to trade the middle. Don't forget, we get that GDP number coming out from our friends in China. We want to make sure we wait patiently and see how the market reacts to that if you're here trading in Asia. Over on the Nasdaq tonight, Nasdaq is relatively simple right now. We get a strong move up into a trading range. That gives me what we call a spike in range. It's a bull bias into a trading range. Anytime I have a bull market into a range, the key is the bullishness before the range, because that tells me I can be relatively aggressive being a buyer on a pullback. But if I want to sell above the top of the range, because remember, we talked about this, right? What does a range tell us? Buy low, sell high. If I want to sell high, but the market's bullish, I've got to be a little bit more patient, right? I need that nested pattern. You got it. So now, all I'm doing now is I want to buy down here, right? I want to get that pullback. I want to buy down here. Take the size of the range, okay? And I'll teach you more about how to draw these ranges correctly inside of our membership classes. But take the size of the range, copy and paste it down, and that will create levels of support. Okay, so these are my key levels of support down here. Same thing. Take the range, copy and paste it up, copy and paste it up. That creates what? Levels of resistance. Those are levels I can sell off of overhead. Now that we have, right, now that we know we have our levels marked up, I'm also going out and combining these two highs, bringing it down to that low, right? Drawing that trend line off the highs, down to that low. That's a great spot too. I really, really like that hidden channel. Hidden channels are just one more layer of support that I can use, and because you can see it all comes together right there, it's a great looking spot to be a buyer. So how do I buy low? Right? Again, mama says, don't fiddle with your middle. right? Don't fiddle with your middle. I want to buy that low. I want to sell that high, right? I'll bet you're never going to forget that rule, right? Don't fiddle with your middle. See, sometimes some bad jokes can really go far for you, right? It's all about memorization for a lot of this stuff. So I'll keep the bad jokes coming if you guys appreciate learning the lessons that come along with them. Anyways, I want to buy low, right? What's a couple ways to do it? One of my favorite patterns in a range-bound market is that strong move down into my level of support. Moving average comes over. Sellers will try to sell off the moving average. Watch out. I know where your stop is. I'm going to buy into their stops, right? The odds are not on their side. They're on the wrong side of the odds. Sellers are on the wrong side of this market at that point. It's not a bear market. It's a bull market. It's just a pullback. And so I'd rather be on the right side of the odds, which means I'm looking for those sellers to fail. That's a failure pattern. Then I don't want to chase after it, right? I don't want to trade inside the range if at all possible. And so I'll look to avoid that by waiting for a pullback. Okay? Easy setups on the lows of that range. What if we go higher here? Okay, what are a couple of things to think about? Well, first of all, if we go higher here, how do we sell it? Right? If we see this market run up, I want to see buyers try once, buyers try twice, and then I can sell it back down. Again, keep your eyes on those levels of resistance up here, right? Let these buyers buy the pullback. Let them try again, right? Again, use the body weight of your opponent against them, right? Use the momentum against them. Let those buyers that buy the shallow pullback, let them load the boat, right, with that deeper pullback. And then once we see him trying once we see him trying twice, then we know it's time to dump the sucker right back down, right into that trading range. Wait for the right signal, right, and we can dump it back from there. Now, what if the market really roars higher here? You know, GDP, China, big news, right? What would a breakout look like? Well, ultimately, there are two basic breakout patterns you want to watch for. One is going to be the 1, 2, 3 breakout. And this can happen in both directions here, right? Let's go lower, for example, right? What if that GDP number comes out horrible and the market runs lower? As we run lower, again, the buyers are waiting here now to buy into that failure. But if they can hold the pullback, if we can get that strong move down, if we can get a pullback to the moving average and a strong move off, what do we call those? We call those 1, 2, 3 reversals, right? 1 being strong move down, 2 being the pullback to the moving average, 3 being that strong move off. Then what do? We mark up that low. We mark up the new low of a new channel. We go all the way up to the top here and grab that high, and that's where that hidden channel is going to be. That's where I want to be selling off the top of that hidden channel. I know, it takes patience. It does. But remember, if you try to sell that first pullback back here, you're not on the right side of the probabilities, right? It's not a high quality trade. You wait for the market to turn bearish now, and now you are on the right side of the numbers, right? Because trading is a game of pattern recognition and probabilities. That's all it is, right? It's pattern recognition. You know, he or she who knows how to spot the patterns. And literally, the more experience you get, the faster you are at figuring out the patterns. That's literally all it is. Right? I just happen to have more patterns of experience than you do, right? I've seen thousands of different ranges. I've seen thousands of different trends. Okay? When you're in my shoes too, you'll have this knowledge too. Okay? And there are lots of shortcuts out there, like working with someone who's already been there. You know, that's the big shortcut, right? The big shortcut is you could sit at your desk for the next 1,000 range-bound markets and learn these patterns, or you could simply work next to somebody who's already seen a couple thousand of those examples, right? And piggyback off their experience. That's a much better use of your time and money, because while you're waiting to learn all this, it costs you a lot of time and a lot of money and losses. We all have to pay our tuition some way, right? Either you pay it to someone with more experience, or you pay it to Mr. Market to learn the experience. Only one is a shortcut though. You know the drill. Okay, so that's the reversal we're talking about. That's the 1, 2, 3 breakout. As we go higher here though, right? As we go higher, I can be a little bit more aggressive here right now. Okay, as we go higher, one pattern, strong move up, right? Real strong move up. Watch the two try breakout, the one, the two, and the go. Okay, so if we see just a move higher here, buyers try once, buyers try twice, we'll sell it back down. But if this thing just launches, right? If it launches, one try, two try, buying from there, right? One try, two try, nice strong signal, right? We're buying that deep pullback. Okay, that's the most aggressive way to do it. You can do it because you're going with the momentum. Now, what's more reliable, obviously, is that 1, 2, 3 breakout, right? Mark up that high, mark up that high, mark up the channel. There's your sweet spot, and we're buying from there. And again, guys, I'm covering a lot right now on this video because if I didn't, right, if I want to give you guys as much as I can here, but I'm not covering everything, right? Because if I did, I'd be here all night, right? This video is already long enough, right? So if you want a deeper dive into all this stuff that we teach and trade together every day in a trade room, grab that free course, right? Put the link in the upper right-hand corner and that big red button. So now we're locked and loaded here to see what they got for that Chinese data, right, over midnight here. Now, over on the gold, okay, what is gold? Gold is a classic example of what happens to a market when it goes 1, 2, 3 legs down. It goes into a range. We just talked about this last week, right, that 3-leg strategy, which we talked about last week, right, on that newsletter, right? So usually when a market moves 3 legs, it usually ends up going sideways. Now, you could say that that's 1, 2, 3, and 4. I mean, you could say there's 4 smaller legs there. I wouldn't argue with you, but I think the way it fits better, it just fits better if you draw it like that. You can pretty much see that's what they were looking for, right? So triple measured move down, 3 big legs down. The most important thing here is they go sideways now. This is a bear market into a range. So ultimately, you can apply the same basic strategy that I just talked about on the Nasdaq. Remember, Nasdaq is a bull market into a range, right? Nasdaq is bullish into a range. Okay, then of course you got the gold, right, is bearish into a range. So it's pretty much the same strategy. It's just the opposite direction. So for example, we know we have a bear market, which means as we go higher here, and again, I've got my levels of resistance here overhead marked up, right? Levels of support down here, all based on that range. I take the range, I copy and paste it up, take it, copy and paste it down. Same thing as I said in the NASDAQ, right? Now, one pattern would be we go up, the buyers, of course, right? The buyers, of course, try to buy the pullback, right? The odds are not on their side. They fail, and I can sell it right back down in, okay? Or we go running lower. Right? With that run lower, I use a slight variation. I let them try once. I let them try twice, right? What do we call that again? We call that a nested 2-try or a nested failure because you're looking for the failure pattern inside of that next try, right? And the reason why you do it a little bit more conservatively at that point is because the market's bearish and I'm trying to be a buyer right now. Right? I'm trying to be a buyer here, and because I want to be a buyer in a bear market, I've got to respect those sellers, right? I'm going to respect their momentum, but then I'm going to use that momentum. I'm going to use their positions against them because once they fail, I can buy into their exits, and their exits are buy orders. All right, guys? And then don't forget, if we can catch that buy off that low, then I can use the pendulum swing. Right? And that will give me that nice big juicy target up here, right? The amount of the move below the range can be the amount of the move above the range. Okay, so on gold right now, I'm looking for a 1, a 2, and a failure back down, or go lower here, right, and a 1 and a 2 and then back up. It's a little subtle difference, and it has to do with the market's momentum. We talked a lot about that in last night's newsletter, and it's a great reason why try to tune in every evening because we kind of build on topics that we talk about every evening right on the video. Okay, now, what if we rally here? What would a reversal look like here? Because honestly, I teased you guys a little bit with this chart. Okay, here is a 30-minute chart of gold. Now, you know me, right? I take a lot of pride in the fact that you don't need multiple time frames to trade. So I want to make this very, very clear right now that you do not need this time frame to make money in these markets. You don't need multiple time frames. However, okay, I've been tracking this for a while because I was just curious to see where this big drop was going to go. Remember, we had this big move down, right? And that put us into that nasty range that gold was in for literally for over a week, just kind of sitting inside that range. Then what happened? We broke above the range, and now we're slamming back down again. Now, you tell me, that's pretty spooky how well that pendulum swing works, right? The amount of the move above the range is the amount of the move below the range, and sure enough, that's where the party ended. Okay, now, this is not a chart that tells me what to trade. This just makes it easy for me to see when I combine that level now, and again, beautiful example of why I love ranges. Because ranges, they tell us so much about where entries will be, where exits will be. I could go on all day about how we trade ranges. In fact, the funny thing is, I have a full chapter on ranges inside that free course, right? Inside that free course, we talk a lot about range-bound markets. So bottom line is, we know this is one big bad level of support. We also know, and again, did you need it? Did you really need that level of support? Not really, because you already knew you were 3 legs down. You know what I mean? That's a good example why you really don't need that multiple time frame. But since we're talking about ranges and pendulum swings, I thought, you know what, let's toss that in just so you can see how well on any time frame those pendulum swings work. But again, make no mistake, you do not need multiple time frames. We find plenty of reliable, high quality trades every day in our trade room without using anything more than one time frame, right? You don't need a lot of different time frames. Now, knowing that, what would I be looking for a reversal? The first thing is a strong move higher, right? Strong move higher. Now remember, it's bearish right now. So I've got to be careful here trying to buy this thing. Okay, here are two things you're looking for here tomorrow to be a buyer. We already talked about being the buyer off the low, right? We got that covered. If you want to be a buyer going higher, first thing you want is, I want to see a strong move up. That strong move higher will set the table for dinner. Okay, it will. Strong move is almost necessary. Because if we see a weak leg here, sellers will sell into it. It'll probably end up back down to that low. You want to see a strong move up. Once you've got that strong move up, one option is that 1, 2, and on this one, I do want to see a trap because I'm going against that trend. Right? I do want to see a trap. Let those bears try once. Let them try twice. Again, it's all kind of bound by, you've got to have that strong move up. Once you've got that strong move up, look for the 1, look for the 2, and we can buy that trap low from there. Okay, that's the trick. Now, the other one would be the typical 1, 2, 3 reversal, right? The 1, 2, 3 reversal. From there, once we see that second leg higher, now it's on. Draw that high, mark up that high all the way down here, right? Grab that low, right? Remember, I'm not drawing it off of that low. Okay, that's why this is a hidden channel. Okay, bring it down, and that's where I want to buy from there. Okay, so 2 basic setups as we go higher. Again, we already talked about if it goes lower as well, right? But now we know the plan, right, as it goes higher. And remember, right, there's no reason why gold can't keep going lower. It's just got to be a 1, 2, 3 breakout, right? I'm not saying I don't want to sell this market, right? I'm just saying what it looks like right now is it looks like the easier money is going to be up, failure, and back down, or down, failure, and back up. Right? I'm okay with it going lower, but just make sure you get that 1, 2, 3 breakout, mark that low, mark that high, right? And sell off of that high from there. All right, guys? And of course, we'll put together some bigger targets here tomorrow, right, in our trade room. Looking good, looking good, looking good. All right, how about some euro here tonight? So euro is, it's tricky, right? This is a tricky one on the euro. The bottom line is we are in go time right now on this euro. Flag pattern. Strong move up, right? Flag pattern. lazy channel, lazy channel, right? That is the calling card, right, for a flag pattern. Now, what happens a lot of times is you get this strong move up, and then you get this lazy channel, right? You get one leg pulls back, then it goes higher, then two legs pull back, then it goes higher, then three legs. Usually, a flag has three legs, okay? Usually three, before we get either A, the move back to retest the high, or B, we get a failed flag, which is usually going to either be a collapse off the low or a move up, a failure, and back down. Okay, those are ultimately the three scenarios we're waiting for right now. Do we just run, end up being a measured move, right? Or do we collapse? Or do we go up, and back down from there? Those are the three scenarios I need to be aware of. So we've got one, we got two, we got three. If I had to guess right now, I would say this market's ready to take a nosedive here. So it feels like. But, I mean, hey, like I said, I think right now, we are right in that ballpark now where anything could happen. Because, again, it's not like we've got 5 pullbacks, right? If this thing was going 1, 2, 3, you know what I mean? If this thing was 4, 5, 6, that's too late. It's probably not a flag pattern anymore, right? It's still a flag in my book, which means it really all depends on what happens next. Now, where's our objective here? Let's go back in time here because there's my range, right? There's the original range here. This is the move above. This is the move below. And now that you just witnessed with your own two eyes how well this pendulum swing stuff works, it's not a bunch of hocus pocus. Okay, 12,800, 12,900, right? That area down there, that's the big objective. Okay, the hard part is the short-term target is back to retest below the range, and then from there, it's the big measured move from there, the big pendulum swing. So I got to be careful, right? I've definitely got to be careful. I've got this thing now stretched out across here now, right? And going to see where we are here right now, okay? I didn't want to worry too much about the range. I didn't want to overcomplicate it here tonight in the video, but that range is going right through it, okay? So how do we trade this thing? First of all, what if it collapses? Right? What if it collapses? If it collapses, you're literally trading it like a 1, 2, 3 reversal, right? 1, 2, 3 reversal. Find that new channel, right? And we're selling off the high of that channel. Whatever you do, just don't chase it lower, right? Don't chase it lower. You want to wait for that strong move down. That strong move down will usually pull back a little bit, give you something to work with, and then you can pop it up high here and use that, right, as your level of resistance. Now, if we do end up just running, right, if this thing just collapses, what's another option for you, right? If you really want to get crazy on this, let the buyers try once, let them try twice, and sell into their stops, right? Buyers try once, buyers try twice, selling into their stops, okay? It looks like this, right? Opposite direction, obviously. Strong move up, bears try once, bears try twice. You're literally buying into those stops. So same thing over here, right? Strong move down, 1, 2, selling into those stops. Where's your target? Again, target's down around that pendulum swing, 12,800 so, okay? Now, the big challenge will be as we go higher, okay? It all depends on the pullback, okay? Write this down, write this down. It's not the pattern, it's what leads up to the pattern. For example, I know I have the top of this channel up here and I want to be a seller. The best way to do that's going to be, I want to see us get up above the moving average. See those buyers try to buy the pullback. It'll probably look like these examples right there, right? Look what happened. We go up, the buyers try to buy it, they fail. We go up, the buyers try to buy it, they fail. Notice that they don't get a good jump away from the moving average. Okay, that's the trick. Go up. We don't get a very big distance away from the moving average. The buyers try to buy it. They fail. And we're looking for that failure into that pullback pattern combination that I've talked about so many times already tonight, right? So again, it's a move higher here, but it's how the market responds around the moving average, right? Do they jump away from the moving average? If so, that's your cue. It's a failed flag, right? It's a flag pattern. If it doesn't, then we know we're going to probably get the same thing we've seen the last 3 times on this and get that 1, 2, right, and that failure back down from there. So that's where I'm looking to sell this sucker back down to retest that low. Now, the other option is it becomes a continuation, right? Now we see the market jump up. Okay, when it jumps up, right, when it really creates separation away from that moving average, look, they haven't been able to do that yet. So if we can get that real big jump away from that moving average, now you know you've got yourself in a bull market again. Now the problem is where's the target? The target's up here. So you basically have 2 different options here. One is going to be the aggressive one, the 1, the 2, the trap. You want the trap here because you don't want to buy into that high. Right? You want the trap right there because you don't want to buy into that high. And trap patterns are the best patterns to avoid buying high. What we would really hope for is that strong move up, get the moving average over, that sets the table, and then get down, look for that failure, and go from there. Right? Let the bears try to sell it again, and we're buying right into those stops. Does that make sense? So again, how do you know the difference? It all depends on the pullback. If we get a shallow pullback and it barely stays above the moving average, that's a bear market still. Right? Get above the moving average, barely stays above it, that's a sell. If it jumps though, now it's either the 1, the 2, a trap and a go, or it's a strong move up, it's the pullback, it's the failure and the go. Let those bears think it's going back down in. We know though how to read a chart. All right, so now we got a really good plan here, right? Now we got a great plan to tackle that, right? Tackle that lazy channel, right? Will it go up? Will it go down? How will the market respond, right, to this overnight news from our good friends in the Far East? Only time will tell right now, guys. But I'll tell you one thing, you guys are ready to rock and roll here for tomorrow. Tomorrow morning, we'll be in our trade room, 8 o'clock Eastern time. Don't forget, we'll start off tomorrow morning like we always do with our morning ritual. Go over all the patterns, go over all the rules, and then we'll trade that 3-step strategy. Speaking of that 3-step strategy, that free trial, yeah, right to the left of my ugly mug, that big red button over there, grab that free trial. That comes with access to our trade room on our free pass. That includes access to our free trading course, so you can learn all about the strategy. And don't forget, while you're looking for the invitation, check your spam folder, right? Sometimes those emails get stuck in that spam folder. So check your spam if you don't see the invite to the trade room, right? Or if you don't see the invite, right, to our mailing list. As always, guys, learn more about membership here on the website at schooloftrade.com. Call me here in the office, that toll-free phone number right next to my ugly mug. I look forward to answering all your questions. Give me some feedback in the comment section below. Be careful overnight with that news coming out of China. And we'll see you guys same time, same place tomorrow morning, 8 o'clock Eastern time in our trade room. If not, we'll do it again tomorrow night, same time, same place on our next edition of our nightly newsletter. Guys and gals, thank you so much for being here. I know it means a lot to me every evening on this newsletter. Thank you so much. Be well out there. Be nice to each other, will ya? And be here next time. Adios, amigos. Bye-bye for now.